for coming today. It is 3 o'clock on Wednesday, October 9th. Thanks for joining me here in our GoToWebinar room. Looks like the audio and video are good. We got the recording started here as well, so we'll just go ahead and get right into it. This is Open House with Patrick Z. That's me, Infinity Futures, established 1995. Again, thanks for coming to the event today. Let's go through some risk stuff first, and then we will, we'll take risk-related questions and then move on. All right, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. Okay, so only fund a futures account with risk capital. Okay, that means money you can afford to lose without lengthening your retirement horizon or affecting your ability to maintain your lifestyle. Okay, if you have any questions about where you fall on the risk capital curve, so to speak, please don't hesitate to reach out to me and let me know. Okay, one other thing, I'm not going to read the entire thing here, but this particular presentation does make reference to simulated trades, some hypothetical trades, trade ideas. Some of these were recorded in real time. Other ones are done with the benefit of hindsight. Just make sure you understand what that implies. If you have questions about what this means, please feel free to reach out to me. Okay, just a little quick background before we get into things. My name is Patrick Zielbauer. That's a photo there on the right of my family and I. That's us standing in front of a really nice truck that I don't own, in case anyone is curious. I've been registered with Infinity since 2004. I'm located in Austin, Texas. Okay, I've been here for about 3 years. I've had contact with thousands of traders over the last 15 years, and as such, I believe there's the ability to provide some unique perspective into the minds and behaviors of traders. Infinity Futures doesn't sell indicators, magic beans or classes. We're here to promote Infinity services and shed some light on how to best make use of your Infinity account. One of the realities here is that a lot of the people in this room are customers of ours already, which is great. What we're looking to do is reconnect with our clients. This is a venue that we can do so effectively and take lots of questions, respond in video format, get lots of feedback. We are really grateful for the opportunity to have you here. So on that note, I would like to say more formally thank you to all of our customers who have joined us in this event. There are some folks that are newer to Infinity. We're going to explain to those people some of the reasons why people do trade here, but I do want to take a minute to thank all of our existing clients. We realize that you have a lot of different places you could go. We thank you for bringing your business to Infinity. There are customers in here who have been clients of ours for many years. We have some really cool tidbits and things to share. I got a couple of images I want to share with you. But what I would like to share with people who are maybe a little newer to Infinity, just to understand where we are at, is this is what I call the spectrum of futures brokerage companies. So what you have on one side is you've got these really big companies, TD, with Thinkorswim, TradeStation, a couple of other larger places that really clearly don't focus on futures. They just kind of offer futures. And then on the other side of the coin, you've got these really small sort of what I call OMS, or one-man shop, and ISFs, which I call indicator sales firms, which are basically, these are companies where they're on the other end of the spectrum. They're also very specialized, but they're promoting products that that are based on sort of selling this idea that the problem with your trading is that you don't have the right tools. You haven't bought enough indicators. We don't really subscribe to that here. Additionally, some of the firms on this end of the spectrum don't offer their own technology. Everything is outsourced, and we believe that introduces an infrastructural risk that has manifested itself in some weird and ugly ways over the course of my time in the industry over the last 15 years. So we'll talk a little bit more about that, but we do believe that Infinity fits nicely in the middle here. We are a company that's been around a long time, 1995. Most of the reps in our office have been here for a really long time. I've been here for about 15 years, for example. There's folks in our office that have been here longer or almost as long as I have. And one of the benefits of working with Infinity is that our parent company, Transact, is an FCM that owns and operates its own technology. We believe that to be a significant infrastructural advantage over some of the companies on this end of the spectrum. All right, so to sort of demonstrate this, I put together this little table. I think this very clearly demonstrates sort of the differences between, the giant impersonal conglomerate type companies and the one-man shop indicator sales companies. So, at companies like TD, Thinkorswim, TradeStation, you really don't know who you're talking to. You might be on hold for 30 minutes. At Infinity, you're talking to the same small group of individuals, usually the same person, but sometimes, one or two or three other people. That's about it. And a lot of the other places don't even really provide phone support. They do everything via email, or maybe the support is different than the brokerage support, software support, et cetera. The one thing we're gonna highlight a lot more later on too is the margin policy. It's very predictable and customizable here at Infinity. It's been that way for years and years, ever since I started. Our focus here is a lightweight, super fast platform, function over form. We acknowledge that when you look at our depth of market platform, it might not look like it was, designed by Apple, I guess, but it's super fast, super lightweight, uses almost no system resources. And those are things that mean something when things are really cranking like they were like not 5 minutes ago when that additional China news came out. A lot of other people I already heard in another trading room, complaining about programs locking up. So pretty neat stuff. And here also, the focus is on trade execution, speed, and reliability. I mean, I always make this joke with these big companies that, brokerage companies are kind of becoming like banks, sort of. You're finding that they are supplementing some of their policies that are not good for futures traders, like the higher rates or high margin requirements, and they're sort of excusing that by introducing these ancillary services that have nothing to do with trading. I always make the joke, like, pay your electric bill out of your trading account. I mean, if that's the reason you make a brokerage choice, I don't even know what to tell you. Our focus here is really on trade execution, speed, and reliability. All right, and going back down here a little further, I believe it does mean a lot that we work with an FCM owned and operated platform. I cannot stress how important that is. That is one thing that's kind of cool about some of the bigger firms, okay? Some of the bigger firms, they have the money, they have the resources to own and support their own tech. That's cool. But what if you could work with a firm who could do that and still give you the boutique feel that you might want? That's where Infinity fits into the picture. We have an FCM owned and operated platform where the platform orders and data, the route to and from the exchange, it's owned and supported by the same company that holds your money. One of the problems with some of these little shops is that the platform, the order routing, the data, the clearing service, these are all provided by individual firms, and you can't really talk to them. They're companies that are contracted by the broker that you're dealing with. If they have a problem, where does the buck stop? Who's accountable? That is something that I think everybody needs to ask. And it's a hard question to answer because these companies don't have an answer. Everything is effectively outsourced, okay? So this table, I think, is a little tongue-in-cheek, but I hope you get the gist of what we're trying to say. Now, another thing that we want to spend some time on today is margin. Okay, margins are becoming a bigger issue. Why is day trade margin becoming a bigger issue? Now, for those of you who are existing customers, we're going to talk in a little bit later about how to best make use of your account in terms of your contract limits and the use of our risk system. We're going to come to that in a little bit. But I want to make note here for everybody that margins are going to be a bigger deal going forward because of two reasons. Number one, if the stock market continues to rally, the bigger companies are going to continue to increase the margin requirements. It's just math. If the S&P rallies over 3,000 and goes to 3,200 or wherever, those margin requirements are going to go up at those places because they base their day trade margin, if they even offer it, on the full value of the contract, which as the contract gets worth more and more money, the margins will go up. So that's one way that margin requirements at some of the larger houses could increase. Okay, the other way that margins at some of the larger houses could increase is if the market starts to fall aggressively or we see a ton of volatility. It's no secret that frequently when we have these big moves, imagine if we have, the S&P drop 45 points 3 days in a row, or if we have another 100-point move or something like that. A lot of times in those scenarios, some of the bigger outfits that don't really focus on futures, they immediately raise their margins. And that can be a problem. It can be inhibiting. We're going to talk about how it can affect individual traders here in a minute, but it is a big deal. And I really can't see a scenario that exists where these margins come down at these other places. I think they're either going to continue to go up based on the market rallying, or they're going to go up because we get a ton of volatility. And you wake up one day and the margin requirement you had yesterday is now 3 times what it was. That is a very plausible scenario that has already played out a number of times with some of the larger outfits. So I do believe margins to be a bigger deal. A lot of people are like, well, I keep enough money in the account where it doesn't really matter. Well, that may not be the case, and especially when it comes to how you place orders, and we'll talk about more, of that as we go. Infinity does have a lot of flexibility with margin. $500 on the indexes, $50 to $100 on the micros. Currencies 500, interest rates 500. Most of the metals and energies we're doing 1,000. So none of these things have really changed at all. We've always had a lot of flexibility. You do want to be aware that if you employ aggressive leverage, that you are mathematically increasing your risk. There's no way to get around that idea. Okay, when you trade with lower margin requirement, or you trade a lot of contracts with less money, you are increasing your risks. Okay, but we will give you some flexibility that a lot of other firms won't give. If you have a trading strategy where it's very risk adjusted and you know how much you're willing to risk on the trade, and you don't have to capitalize the account with $25,000 to take the position because you're only risking $700, then why would you capitalize it with $25,000? Just to let the broker tie that money up so you can't use it somewhere else? That's generally the argument. Okay, so the other thing to note is that the day trade margin does work for 23 hours a day on most markets, including the ones listed here. From 5 p.m. until 4 p.m. the next day, you can use the day trade margin, 23 hours a day. Okay, one thing that is interesting about how day margin impacts order entry is everybody here aware that when you put an order in, that you go into a line? You go into a queue, right? You put an order in, you're behind 400 other orders. The order goes in. If 20 of the contracts get filled and the market bounces off, you don't get filled. All right, that's a pretty, it's common knowledge, I would say. A lot of our customers do like to stage orders in advance on the DOM. I'll pull up a DOM here in a minute and show you what that might look like. But the general idea is that with some of these larger companies, they're going to count every one of those entries against your margin requirement, even if you don't intend to get all those orders filled. So let's say you buy one here, you put one here, you would put one here, and you're thinking, okay, if one of them gets filled, maybe I'll modify the other one lower, or I will cancel one of them. With the flexible margin we provide, you have the ability to stage those orders in advance, which means you can be earlier in line in the order queue. If you're placing an order in the E-mini S&P one tick away from the market in a relatively calm market, you're going to be behind several hundred contracts. It may be very difficult to get a fill unless you're traded through immediately. But day margin can impact your ability to stage orders. I'm a big fan of order staging in advance because I like to look at order entry methods or strategies that are based on price levels that don't necessarily change minute to minute. So the orders might go in and they might sit there for hours and hours. That means that there's a good chance that I'm near the front of the queue. So if the market comes down and touches that level, you're more likely to get a fill because you're not placing the order at the very last second. So the flexible margin policy that we offer will allow you to place additional orders in the market if that is something that you want to do. And just in terms of cost of capital, opportunity cost, like I said before, if you're trading in a way where you know what you're willing to risk, the general argument is, why would you tie up a whole bunch of money that you know you're not going to deploy? Just because the broker asks you? You have a lot more flexibility here. And certainly there's an argument to be made about opportunity cost. What could you do with the money? Maybe you could leave it in your bank and earn some interest. Maybe you could buy an extra share of Amazon. Maybe you could do something else with it. Okay, if you don't need to have it in the account, then you don't have to keep it in the account. We will still give you a lot of flexibility when it comes to margin. Why do big firms jack around with margins all the time? The main reason, in my opinion, why that happens is that some of the larger firms would rather prevent you from actually trading than earn a commission on your trade. So if the markets are moving a lot, their thought process is basically like, okay, if we let Tom trade, there's a chance, Tom goes debit, Tom goes below his balance, or goes below zero in his account. And, would we rather make the commission on the trade, or would we, rather not make the commission on the trade, but have no chance at having to chase down Tom for his, $500 debit that he has? Okay, that is, in my opinion, the way that these generally more risk-averse firms approach margin. So typically what you'll see when you wake up and you look in your email and it's like, okay, Susan, your margin requirements for today in the E-minis, yesterday they were $1,500, today they're $6,500. That is something that you're more likely to see with, with some of the larger outfits. We have gone 15 years, at least as long as I've been here, without a day margin increase in the indexes. There are a couple comments, Mike, and a couple other people were asking about, how do we handle that from a risk perspective? I guess the best way I could say it, Mike, is we have been through an enormous amount of volatility and very odd and crazy scenarios in the time that I started here. Okay, we could go back to 2004 when I got started. We could go look at the financial crisis. We could see the flash crash. We could look at the tsunami in Japan. A bunch of things sort of stand out in my mind. Whenever news comes out of China, the tweeting, all that stuff, these create volatile markets, but yet we are here still standing and still offering a lot of flexibility. So it can be done. And, we are a hallmark representation of the fact that it indeed can be done. And, we're still doing it. One of the examples that I can give about a larger company sort of adding premium to margin is TOS. If you have an IRA account, and we do get questions about IRA accounts because you can trade futures with IRA accounts at Infinity. TOS will actually, TD Ameritrade rather, will actually add a premium to overnight margins for IRA accounts. So I don't know, I can't give you a specific number in this example, but let's just say the overnight margin on the NASDAQ is, $8,300. Okay, they might make the overnight margin 10,000 just because. So brokers have the ability to do that. It's just typically firms who specialize in futures don't. Okay, bottom line is we have a ton of flexibility, and we've demonstrated our ability to maintain that through some pretty wild, some wild market conditions. One thing that I'll mention as well is that a few times a year, lately more often, these volatility events that we see drive interest in our company. So it's almost always when there's a huge move in the market and a lot of the bigger companies will turn off the day trade margin or reduce the leverage ability. And all of a sudden we get all this random email and phone calls. Hey, did you guys raise your margin the other day? Or, what's your margin like on the E-minis right now? And so that is something that just routinely happens. Every time we see a massive move and one of these companies changes their policy, we sort of move the goalpost further and further away in terms of the ability of retail traders to trade. And that's how a lot of you got here, to Infinity. So, these volatility events are something we thrive on at this company, and our platform and our risk system are, hallmark testaments to our ability to maintain access to the market for our customers. I would like to give an example too. For those of you who are, clients here or just learning about futures, this is something that I really think our existing client base as well, could benefit from. Even with the overnight margin requirements, futures are very, very efficient instruments. So I did a little example just based on the SPY yesterday. So if we just assume for a minute that the E-mini S&P was trading at 28.85, which is where it was when I made the slide, and it's $50 a point, that means that the full contract value of the E-mini S&P is $144,250. Okay, the maintenance margin on that contract as demanded by the CME, which this can change, was currently $6,300. So the question is, if you're trading stocks, like if you're an SPY trader, how many shares of SPY do you need to put on in order to get $144,250 worth of exposure? And the answer is 500 shares. So in order to take a trade that's worth the same as one E-mini S&P, in your stock account, you would have to buy 500 shares of SPY. And I think this is a good example of why futures are considered to be such efficient instruments. It's because you can take a position that's relatively large with a reasonable margin requirement, and if you are going into a position with a fixed amount of risk, it goes back to the question, why would you put up the 144 grand when you could do something else with it? So here's an example. And for those of you who have accounts where you're in and out throughout the day, if you want to do this, you could actually open up a sub account with us, add some money to it. And if you just want to be long the stock market, you could actually just put on an E-mini S&P separate from your day trading account and just be long, or the Russell or the Dow or NASDAQ or crude or anything. As long as you have the overnight margin required to hold that position through the close, you could actually utilize the effectiveness of futures from an efficiency standpoint as like a side separate account from your main day trading account. And they wouldn't interact with each other in terms of the trades. So you can keep them separate. They even show up on separate statement pages on your PDF statement you get from us every night. So if you have this idea of, okay, I want to do a little day trading, but I'd like to put on one E-mini S&P separately with nothing to do with my day trading account, you could actually do that. So if you look at this hypothetical trade example, let's say that you went into this where you're saying, okay, I'm willing to risk 5,000 bucks. So I'm going to buy one E-mini S&P, or I'm going to buy 500 shares of SPY. So you buy the S&P, 2885. You have to have the $6,300 exchange minimum margin. Okay, if you want to do the same thing in your stock account, you put your trade on 500 shares at $288.53. You put in $144,000 into your stockbroker account. Now, do you have to pay margin interest with us in a futures account? No, there's no margin interest. If you are trading in your stock account with any less than this amount, the answer is yes, you will pay margin interest to your stockbroker. Okay, that's a bummer. So if you want to put, let's say, 75,000 in the account and take the same trade, you're going to have to borrow the balance of that, about another 75K from your broker, and then pay them interest on that balance, right? And then from a tax perspective, if you make money on the futures trade, even if the trade lasted 1 day or less, you get 60-40 tax treatment, which is preferential. I mean, depending on your tax bracket, that can be about a 10 or 11% different tax rate than short-term capital gains, which would apply in your stock account. So it's pretty amazing. I mean, futures are an extremely efficient way to maintain exposure to the stock market. So if you are a regular Infinity client with some money in your account and you're doing some day trading, but you would love the idea of just having some longer term exposure to the stock market in an efficient manner, you could certainly make the argument, why would I put up 150 grand in my broker or less and pay interest when I could just put, maybe I put 10 or $20,000 in a futures account and put one E-mini S&P on and just forget about it for a while. That could be your exposure to the stock market. And if if you make money, you get tax benefits. So this is something that everybody can do, whether you're looking at futures to foray into futures for the first time. If you're an existing client already trading here and you wanted to add some money or open up a sub account or something to do this, you could definitely do that. All right, so just going back to a couple of things that we offer here. I'm not going to read through the entire list, but the summary of what Infinity does is, we have a platform, we have a data feed, we have a charting program, we have flexible margins, we have personalized service. We also connect to a few other outside companies' charting programs. One of those companies is called Sierra. We'll talk about that a little bit as well. But Infinity Futures provides a wide range of services, even though the futures trading world is a relatively narrow, sort of singular industry. We handle all aspects of it. We handle the platform, we handle the data, we handle the flexible margin, we handle the charting. We can even handle the charting if you want to use some other charting companies that we work with. The InfinityAT DOM that you see here, this is the core of our business. Okay, single click, place, cancel, flatten, reverse, extremely lightweight. Again, FCM owned and operated. You can do some cool stuff with respect to bracketing, automatic scale outs, breakout brackets. The way that I like to describe the DOM in terms of functionality is that it's just got just enough functionality to be dangerous, meaning you can do some really neat things that don't require you to be a programmer, but it's not loaded with useless gadgetry that is just going to screw you up or confuse you. It's got just enough for the vast majority of traders. You want to put a 3-lot on, you want to have 3 1-lot targets. When your first target is hit, your stop goes to break even plus 1 tick. Not a problem. You can do that really, really easily with this program. All right. Another thing I'd like to mention too, to people who are sort of thinking about this, but they're thinking in their mind like, wow, I just spent, 10 years learning Thinkorswim. I just can't bear the idea of stopping that program. Our program runs easily alongside basically anything. And the reason it does that is because it uses no memory. So if you look at your task manager on your computer and you pull up, our platform, our executable process that's running, you're going to see it's using less memory than almost every other thing you've got running. Your other programs aren't even going to notice it. Thinkorswim, TradeStation, I'm not joking. These platforms are using 100, 200, 300 times the amount of memory committed to the InfinityAT platform. I'm not exaggerating. It just depends on how heavily you use those programs. If the best way for you to get started with us would be to just use the DOM, and you don't really want to commit mentally to the idea of learning a new charting program, fine. Just run our DOM alongside your other program. Tons of people do it. And eventually when you have some time and energy to learn our charting program, do it. But you don't have to commit to this huge task of, this gargantuan adventure of learning a new charting program just to become a customer here. You could just use the DOM. Most of you could learn it in 10 minutes. All right. AT Charts. AT Charts we released a few months ago, basically in June. It is an unbelievable program. It's web-based, extremely intuitive. One of my customers used the term hover to discover to describe how easily the program is to use and learn, meaning you put your mouse over stuff and it just tells you what to do. All right, it works right out of the box. It runs in a web browser, runs on any device, runs on an iPhone, runs on an iPad, runs on an Android device. It syncs up with the DOM, so if you want to see trades, you can see your orders on the DOM. You can log in on your phone and see the orders from the chart. We have some videos on our YouTube channel that show how in sync they are. It's pretty cool. Reduce connectivity issues because it just connects to a browser. All you really need is an internet connection. You don't have to disable your antivirus software and deal with all kinds of random internet issues. And because it's vertically integrated with your account here, we can support it round the clock. It's not an outside, product that you have to lean on another company for support. So it's really neat. The other day, a couple weeks back, everybody remember when crude opened up that Sunday night, up $5 or $6. I was sitting on the couch with my wife, like looking at the market, and I recorded a video on the phone. I was so shocked as to how smooth this thing looked in a fast market like crude on my Wi-Fi at home that I recorded a video of it on my phone and posted it on our YouTube channel. It's up there somewhere. I'll try to find the link and send it. It's a great representation of just how fast this thing is, even though it's, it was on my iPhone. So pretty neat stuff and really, really easy for everybody to learn. If you do 10 round trips in a 30-day period, then we waive the fee that we would otherwise charge for the charts, which is $12. So it's really cheap anyway. It's optional. And if you decide to use it, all you have to do is do 10 round trips in 30 days, which is not hard for our typical customer to waive the fee entirely. Okay, so a couple questions that have come up over the last couple months about Sierra. So Sierra is a program, an outside company who has a charting program called Sierra Chart. And we have supported Sierra for many years. I mean, maybe 10 years, maybe I can't remember exactly, but I myself have done hundreds of videos and live webinars about Sierra. We do offer and support Sierra Chart. It's $20 to $30 a month. That is still cheaper than getting it through Sierra directly, and in my opinion, with superior support. So one of the gripes that people have often with Sierra is that you can't call them. They do everything through a message board. It's, they're not known for their client support. It's not a very friendly environment. They're effective, but you can't really interact with them and get personalized help in most cases. You're often going to be referred to documentation and that kind of thing. So at Infinity, if you want to use Sierra, okay, if you need it for some reason, you can get it here at a cheaper rate than you would if you were to pay Sierra directly. So just know that, okay? It's billed directly out of the account. It's supported by Infinity representatives. And you just have to ask yourself, is it for you? It's a bigger program. It's very robust. It's got lots of functions and tools and settings and windows. So if you are willing to make the commitment to learn it, and there are some things in there that you need, maybe you bought something that only works on it or whatever the reason is, no problem. We will happily support you on it. Okay, it just so happens that a lot of our clients and prospects have been asking us for a simpler solution that doesn't require, a collegiate level education, class to get your head wrapped around. Okay, Sierra is a great program. We do offer and support it. If anybody needs to use it, perfectly fine. Okay, I want to talk a little bit about the risk system. Actually, but before I do, I want to read a comment from someone in here just a moment ago. It says, your Sierra support is awesome. Many other firms support so many chart packages that they are the masters of none. That is, I wish I couldn't have said that better myself. That is exactly the point I was trying to drive home. Some of these companies, they're kind of like a superstore of platforms. It doesn't actually help you for your broker to offer 100 platforms. What does that actually mean? What does it do for you? All you're going to end up with is dealing with a company who supports 100 platforms, like 1/100th of the way. That is the whole thing we've been trying to avoid. So if we're going to commit to something at Infinity, we commit to it. And I think we demonstrated that, through our support for Sierra over the last, however many years. So I hope that's, clear to everybody. All right. So this one is going to be a little bit more for the existing clients in the room than the people who are exploring us. But everybody who's exploring us, you should still pay attention to this, because this is one of the critical parts about understanding your account with Infinity. So we have two elements to our risk management system here at Infinity. Okay, we have contract limits and we have a daily risk level. So the contract limits are unique net position limits per market. What that means is, if you have a contract limit of 3 on your S&P and you buy 3 S&Ps and then you try to buy a 4th one, our system will reject the 4th order because your limit is 3. That might be the case if you have $3,000 in your account, or if you have $300,000 in your account. That is because the position limits are not necessarily tied to your balance. Sometimes people call us up and say, look, Patrick, I have $80,000 in my account. I've had some trouble with discipline in the past. I don't want to be able to buy 80 or 100 E-minis. I know you would let me. I don't want to be able to do it. We could actually reduce this client's limit on the S&P to 6 or 8 or 12 or whatever it is they want. Why should a trader arbitrarily lower their limits? Well, it's a new platform. Maybe you're afraid of double clicking in the wrong spot. Maybe you're afraid of, you've had some judgment call problems in the past and you're worried about trying to double or triple down to dig yourself out of a hole, and you're just going to dig a deeper one. Okay, maybe it just makes you feel good to know that there's a little bit of a circuit breaker in between you and a 100-lot position. All these things are great because they allow you to focus more on the trading and less on these outside issues. The markets, the limits can be different for each market. You might say, okay, Patrick, I would like a 10-lot limit on the S&P, NASDAQ, and Russell, and a 4-lot on crude and a 3-lot on gold. No problem. We're going to give you a support desk you can contact. You can make the change, usually within a couple of minutes notice. We have a 24-hour desk that's staffed from Sunday evening until Friday's close. And our support team can make adjustments to your limits under normal circumstances with relatively short notice, sometimes in like less than a minute, okay, no joke. So I highly recommend, if you are a live client and you have not thought about what your limits are, inquire with your representative, whether that's me or someone else, about what your limits are at and how you feel they should be set. It's a great way to sort of check something off your list of things to worry about, okay? It's nice knowing that your limits are in place. If you are very successful, if you add money to the account, if you want to increase your limits, just let us know. We can make changes, again, within usually a couple minutes notice. It's really, really easy, okay? So contract limits per market, they vary from user to user. We don't blanket everybody with the same requirements. They can be different from one market to the next, and they can be changed. Okay, if anybody has any questions about the contract limits while I start going through the risk limit stuff, now would be the time to ask. All right. Okay, the daily risk limit. The daily risk assessment level, rather, is a negative dollar amount where if you add up your open trade equity, OTE, plus your cumulative P&L, which is your closed P&L for the session, will trigger an attempted liquidation. So let's just say that your risk limit was $2,000 and you're in a trade that is minus $1,200. And earlier in the day, you already lost $800. Okay, 1,200 in open trade, negative 1,200 in open trade equity, plus negative 800 in cumulative or closed P&L equals negative 2,000. Our system is going to trigger a liquidation attempt. So what is this for? Well, the plain answer is it's designed to protect the firm and customers from debits. You heard me talk a little earlier about debits, with some of these bigger companies being afraid of people going below zero. Yes, we don't want clients going debit. We believe that customers should manage their own risk, use stop orders, do not rely on the risk system as a stop order. It's not guaranteed. Okay, it's in your customer agreement. You just shouldn't rely on it in general. Use your own stops. But again, it is generally wise to think about where your risk limit should generally be. So here's an example of what I mean. Let's say you have 50,000 bucks in the account. We would typically start the risk limit off at 30,000, which is 60% of the balance. That's normally where we would begin, unless there was some other, other circumstance that dictated otherwise. Now, that customer might say to me, look, Patrick, my personal daily risk limit every day is $2,000. There's no way I should ever be down 30 grand in a day. I mean, so that means that either I'm off the deep end, or I put a whole bunch of orders in and walked away and passed out and they all got filled and now the market's screaming again. Who knows, right? This person might say to us, why don't we reduce the risk limit from 30,000, say, to maybe 5,000? So we don't want it anywhere near where you would be getting yourself out. We don't want to tag you out of a trade that you wanted to be in. We don't want the situation to occur where you're getting stopped out right in that exact moment our risk system is triggering an order in the other direction or something like that. We want it far enough away where it should still never ever be hit. But like the contract limits, it does represent kind of a security blanket for people, I have found. So somebody's got 10,000 bucks in the account. We set the risk limit to 6,000, 60% of the balance. They may say to me, look, Patrick, my risk limit every day is 500 bucks. Why don't you reduce my daily risk level to, say, maybe 1,000? That way, if I lose it or something goes off the deep end and you guys end up successfully liquidating me, which again I want to stress is not guaranteed to happen, but let's just say it did, now that person has lost $1,000, and sure, I mean, maybe the market would have come back, but what if it didn't? What if it just kept going and going and going and that person would have blown up the account in one day? God forbid. So it acts kind of like a security blanket, something to think about. Okay. All right, any questions about these two items? This would be a good time to ask. Okay, a couple questions that did come through. So Jersey asked earlier about does the AT charts have the same work? Can you convert a workspace from Sierra to AT charts? That might be possible. It depends on what you're doing in Sierra there, Jersey, but if there's something specific that you need to see that you're not sure exists in AT charts, we would love for you to contact me so I can find out what that is so we can help you make that transition if possible, okay? The liquidation fee, Glenn, yes. So there was a question that came through about liquidation fees. So if you're using the Sierra chart program, there's a liquidation fee associated with hitting your daily risk limit. It's basically a deterrent. It's $5 a contract. So if you hit your risk limit, you're going to get dinged for the daily that cost. I would like to mention that is basically, as far as I know, the lowest amount in the business. There are a couple other companies that were on that right hand of the spectrum that I mentioned earlier that actually charge like $25 a contract. So there's one in particular, some of you might know who they are. They advertise very, very low minimums. They are continually attempting to get people to fund with very small amounts of money. We always couldn't understand why that was until we realized that they charge a $25 per contract liquidation fee. So light bulb on, it makes sense. Get someone to fund an account with 300 bucks and then blow them out of a 6-lot micro and charge them, a $150 fee on the way out. We get it now. So we don't have excessive liquidation fees like that. There are liquidation fees if you hit the risk limit and are using the Sierra chart package with us. They are minimal, and frankly, the risk limit should never be hit in the first place. So it's very easy to avoid those if you're managing your own risk, but certainly something to be conscious of. All right. Okay, can you unlock the risk limit if you're hit that day? So yes, Patrick, I had a risk limit of $500. I hit it. Can you please turn me back on? I want to try to take one more trade. Or do I have to wait till tomorrow? The answer is you can go ahead and get unlocked. So if you need to get unlocked that day, you can let us know. Again, within a couple minutes, we can usually unlock the account and have you up and running right away. I generally speaking, I would discourage this because we don't want you to fall into this behavior of hitting the risk limit and then kind of calling us, and then we unlock it and push it further, and then you hit it again, and that is kind of defeats the whole purpose of it. One of the objectives here is to have you kind of take a cool off break and maybe tackle it again in the next session. But if there is a situation where you need to be unlocked, then you certainly can do that. Okay. That's correct. If you are using AT charts, the liquidation fees do not apply here. That is accurate. Good question, or good point. Okay, let me keep going here, then I'll answer some of the other questions that are coming through. So there are a few things that as existing customers you can do to get the best experience out of your account with us, okay? One of those things is read your statements every night, okay? I realize that that's like number 500 on the things you need to do in the evening or early in the morning, but when you get the notification that your statement is generated by Transact, log into the portal and look at it, especially on Friday or Saturday or Sunday morning sometime. If you are leaving yourself in a position by accident on a Friday afternoon and you come in Monday and you didn't know you were in a trade, no mercy from me, okay? I say that tongue in cheek, but you absolutely have no excuse to not be able to get yourself out of that position on Sunday night. Make sure you read your statements. If you for some reason left a trade on, then one of the number one preventable, loss prevention type scenarios is you got yourself into a trade, you forgot to cancel an order, you got filled on something Friday, you left it on, Sunday night the market opens flat, you have an opportunity to get out of the trade because you realize what happened on Saturday or Sunday morning sometime, and then you don't, and then there's a 30-point move in the S&P Sunday night. Of course, it goes the other way, and you end up taking a hit. All right, make sure you read your statement every night. Cancel all your orders. Okay, make sure if you need to check with our help desk, feel free to do that. You can email them, call them, and say, hey, account number is so and so and so. Can you please make sure I'm flat and I have nothing working? No problem. We actually appreciate that because we can see that you care enough to check yourself. It's good. It's a good habit. So make sure you check your statements, especially Friday statement, because if the market opens up Sunday and it opens flat or opens in your favor, you might have a position or the opportunity to undo a mistake that could have been bad. Okay, if you wait till Monday morning and you just had no idea because you just didn't look, that could obviously be a problem. All right. Know your daily risk limit. Okay, when you log into the platform, their daily risk limit is printed in red letters on your login screen. Okay, so when you log in, user, password, account, you're going to see the risk limit show up in red letters there. Okay, if your risk limit is $500, and then you see that and you log in and you're trading and you get dung out by the risk system at minus 500 or 550 or something like that, you got to know where that is. If you had it, maybe you had it really low one week because there was a lot of volatility and you were just kind of tooling around and you didn't want to have a wide risk limit, so you had us reduce it, and then you forget to reduce or increase it again on Monday morning. Make sure you know where the risk limit is. It's your responsibility to do that. We make it really easy. When you adjust your risk limit, or if Transact adjusts your risk limit, you get an email to the email address that's on record. You should always know where that's at. Okay. Check your open order window and the completed trade window. I'm going to show these here in a little bit. Make sure you don't leave anything out there. Okay, that's a very preventable, mistake, potentially costly. Murphy's Law usually suggests that if you get into something and you're not in it on purpose, that it's more than likely going to go against you. Okay, very few of these things work in your favor. Best to eliminate the possibility altogether. All right, if you hold positions through the close, understand overnight margins. We can give you links to the CME's website, which is the best place to obtain information about overnight margins because they do change from time to time. So if you're in a position, that's S&P, NASDAQ, Russell, crude oil, Euro, something like that, and you're unsure about whether or not you have the margin to hold the position, then check with us. Okay, we will gladly check for you. If you're in a spread position or something and you're not sure what the margins are, our support desk can actually run a margin check on all the positions in your account and give you a margin number that represents everything you've got, including any spread credits that might exist, by the way. All right. Keep the overnight desk number handy. Everybody who's a client should have it. If you don't, let me know via email. I will send it to you. If you're not a customer yet, you will get the number to our help desk as soon as your account is funded. It's all over our, sort of ready to trade. Here's how to get started sort of welcome letter. All right, you should always have that number handy. Put it in your phone, tape it to your desk, put it in your pocket, wherever you might need to call from. That is obviously important. And just make sure you have solid connectivity. One of the nice parts about the web-based charting, AT charts, is that you can pretty much use that from anywhere, but just be cautious. I mean, if you're on Starbucks Wi-Fi, I mean, besides the security risks associated with stuff like that, just make sure the connectivity is solid. And if you need to call, don't be afraid to call. Don't just not call because you're not sure. If you put an order in, you're not sure if it got through, or if you're on a bad cell signal or something. Make sure you have solid connectivity before you trade. That 24-hour desk number is there to help you, and make sure you call it if there's any question. It's always better to call to check than to take a chance, because mistakes in the futures industry are usually costly. Okay, we don't have a lot of $25, $50 problems in our business, right? It's always 500 or 2,000 or something like that, just because of how levered these contracts are and how volatile they are. All right. Okay. I want to talk a little bit about some of the issues that we see, among day traders, and there's one in particular that I'd like to focus on, and we'll highlight some of these things, take some questions. There are some questions that came through as well that I plan to address. But let's start at the top, and we'll run through a few of these. There's a couple that are more important than others. Lack of respect for leverage employed. I talked a little bit earlier about that. The 500 share of the SPY, being equivalent to one E-mini S&P, about 144,000. Very few traders actually know the full contract value of the assets they're trading, which is kind of surprising. It's kind of like, putting a down payment on the house and just asking what is the lowest down payment I can put without ever asking what the house is worth. Okay, if you're going to trade an asset, a financial asset, one would think that you would want to know what the full value of the asset is, even if you plan to only be in it for a little bit of time. There's a general lack of respect in the retail trading community for the leverage that is present in futures. I'm not saying that to insult anybody. It's that no one's taught this. It's not part of the discussion usually when you're being taught what and what not to do. I think it's important to keep things in perspective in terms of the amount of money that each contract is worth. A really good example of why this kind of thing is important would be like if you wanted to trade one of the major indexes and you wanted to trade the smallest one, the one that's worth the least, it's the E-mini Russell by far. It's worth about half as much money as the other indexes. So if you want to be able to take a position where you can use a wider stop percentage-wise and not necessarily risk as much money or more money, the E-mini Russell is not a bad market, if that is one of the criteria for your game plan. That's something we can answer more questions on further. But I would say spend a little time understanding what the actual contracts you're trading are worth. Just take the price of the index multiplied by the point value. Okay, if it's not an index, if it's something like gold, take the price of gold, multiply it by the full point value. Okay, 1510 is the price of gold, multiplied by $100 a point, it's 151,000. Okay, crude oil is trading at 52.68. Every full dollar move is $1,000. The full contract value on crude is about $52,680. Okay, so it's really simple math. You just have to know the price of the asset and the point value. Multiply them together, and that yields the full contract value. All right. Another obvious thing here is poor decision making yielding a positive result. So this is a function of the fact that you're in your office, you're in your house, you don't have a risk manager looking over your shoulder, slapping you in the face or the back of the head every time you make a mistake. One of the main problems I think with retail trading is that poor decision making can yield a positive result. Okay, you double down on your position, it's not part of your plan, you shouldn't do it, you end up making money because of it. What do you think you're going to do next time? It's so obvious. That's why I don't want to spend a lot of time talking about this, because everybody knows that's an obvious one. That's a really hard thing to untrain. Once you fall into that, you really got to spend some time trying to get yourself out. Okay, trading chat room FOMO. This is like public enemy number 2. Okay, trading chat room FOMO. You're in the room, you're listening to people talk. Hey, anyone else catch that NASDAQ runner? Boom, 18 points. Firstly, you don't even know if that really happened. Okay, that is a real problem. There is a fear of missing out, FOMO. Anyone doesn't understand the language of the young kids these days? Okay, FOMO, fear of missing out. Trading chat room FOMO creates anxiety
even for me, and I'm not even trading futures contracts intraday. So I can only imagine what it does to all of you. All right, just bear in mind that you're not seeing behind the curtain. I've had situations before where I know who the guy is in the room because I recognize his username and he's talking about trading, and I look at his account and there's no activity, but he's trading. Just be aware that, try and block some of it out. You can still get what you need out of the analysis and the learning if you're in a trading room that you feel is valuable, without listening to all the other people in the room talk about what they may or may not be doing. Try and release yourself from the obligation of following it all. Okay. The next thing, technology and excess information, is, explanation seeking. One of the problems, generally speaking, in the futures industry is in the education and technology space. We are being asked to process more and more data. Every day it's more information, more indicators from different angles, different indexes, this or that. It is really easy to start going down the path of seeking an explanation for why something that you didn't work. And the problem with that path is that it leads to just massive amounts of indicator purchasing. And that's one of the things we really are trying to help people keep in check. There's nothing wrong with taking an idea or some inspiration and applying, a study that you feel is useful as the basis for helping you make that decision. But it can get out of control quickly. And what I have found in dealing with my customers is that there is this shift from what I just mentioned about using something as a tool, like something to help them through the process. It shifts from that to the reason this failed is because I didn't have that. And there's what it is it's our ego trying to explain away our failure and help us find a solution that doesn't involve us acknowledging our own problems with how our decision making begins to crumble in a live environment. So the more aware you can be that is a tempting thing to do, the easier I think it is to sort of fight that inclination. So it's it's a little bit of psychobabble, but something I've seen in my own behavior as well. And then the last thing that I think is actually the most important is, this is number one, okay? Number one is the inability to sacrifice open trade equity to try to catch a runner. People do not want to give back unrealized gains. It is like mortal sin number one. I believe that to be a huge problem. When people ask me, Patrick, how am I ever going to catch a trade, in the NASDAQ that just keeps going like this? Here's what I'm doing. I'm putting in a 10 tick stop, and then I'm trailing the NASDAQ by 2 ticks. Why do I keep getting stopped out? Well, how are you ever going to catch a trade that runs with a stop that tight? I'm not suggesting that you have to never move your stop like to break even, but I think it is worthwhile to try to train yourself to, if you find yourself in a position that is working and you're up a few $100 on it, you might be better off just getting that stop in at break even, leaving, and then come back at 3 o'clock and see what happened. There's only really one of 3 potential outcomes. There's, you got stopped out. Oh, well, the market didn't go anywhere. You're still in your $200 winner, or maybe a modest winner, or maybe at the end of the day, you caught something in like the NASDAQ or the S&P that ran $800 or $900. There's almost no chance. Okay, maybe you're different, but most people I think are like me. There is almost no chance that you will catch a trade that runs that way if you are sitting there watching it and micromanaging your way out of it. I just don't think it's possible for most people. It is a real issue, I think, for people who feel the need to tighten stops up so quickly, and it just gets them into another trade. They get stopped out, another trade, and they give it back, and it starts this vicious cycle. Take the day off, put the stop in at break even, leave, maybe check the position from your phone once, come back at 3 o'clock and see what happened. All right, it's going to be a little painful the first time you get stopped out at break even and you give back all that open trade equity. It doesn't feel so bad afterwards once you start to realize that it is a necessary part of trying to catch a trade that just doesn't quit. All right, so that's something to think about. I really do believe that that's I think that really is public enemy number one. All right, I'm going to post a link to this because we are a little bit short on time because I babbled a little bit long here, but I do have some general ideas about trading based on my experiences with customers. One of these things I learned a lot from this thing called MPD lines that I picked up from Raghi at Simpler Trading. There's a couple people asked me about some of their stuff as well. These existed, before I heard them from her. But basically, an MPD line is a set of bands, kind of looks like Bollinger Bands, but it's basically based on the day's range and the VWAP, the volume weighted average price. And it basically poses the argument that choppy markets are not always bad. This strategy works less in big trending days like what we've seen lately. So you have to have the wherewithal about when to look at something else. But there is sort of this thing that happens in the chat rooms where it's like, oh, back to the chop, can't trade this chop. I don't necessarily think that that's true. There was some really good opportunities today throughout the day in what was kind of a slow, low volume type day because the big move happened early and then there were some little moves later, but a choppy market is not necessarily a bad market. If you are a reversion to the mean style trader, if you like the idea of doing some counter trend trading, if you like the idea that, you can stay out of the middle of the range using these sort of more extreme levels, I think that there is value there for a variety of reasons. Okay, I'll skip through this. This is a few days old. We took it from another event, but I do take a lot of notes when I'm recording these in real time. So I'll let you go back to. I'm going to post some links to some of the recordings. If anybody's curious about that, again, this is free stuff. Okay, this is not like there's no class for sale at the end. All right, this is built right into our program. And I highly recommend that if you find yourself, if you're looking for some place to start over, if you've bought $10,000 worth of indicators from that only work on Ninja Turtle or something like that, and you're looking for a new place to get started, this would be a great way to to maybe explore that. So why do I generally believe in the idea? It basically centers around the idea that you keep yourself out of the middle of the range. Okay, there's this theory, this thing that people say sometimes, trading around the edges. Okay, usually there's a flurry of activity around these extreme areas, and it requires people to be patient and stay out of the market a lot. That means it reduces trade frequency, it forces patience, and because the levels are just based on the VWAP and the range of the day, the time frame doesn't matter. The levels don't change if you're looking at a 1 minute or a 5 minute or a 60 minute. It's awesome. So sometimes people ask me, why do I have a 5 minute chart up? It's because that lets me see all the number of bars I want. It's not because the indicator or the theory is any different on a 5 minute time frame than it is on a 1 minute time frame. It's all the same stuff. And it does encourage this sort of walking away idea that I described earlier. And one thing that I think that is important to note, that is the last thing in this list of bullet points, is that losing really sucks. But there is definitely something to be said about the fact that losing in a certain way is more debilitating than others. Okay, if you are trading off these MPD lines and you're trying to sort of catch a falling knife a little bit, but you're doing it gently and you're doing it with maybe some micro contracts, or you're not getting in too heavy too quickly, and the thing just continues to break and it blows through everything because China, Trump, or this or that, you take a hit. I mean, you were just wrong, flat out wrong. There's a big difference in what that does to you the next day and how it affects your decision-making ability than if you were doing this 5 times in a day where you get tagged out of something because you were 30 seconds early and then you get stopped out and then the market runs the other way without you 10 seconds later and you just want to go crazy. I think that that changes your behavior, I think, in a lot worse way than maybe taking 1 or 2 trades a day based on pre-entered or pre-planned staged trades and just being flat out wrong. All right, I put that caution water on road during rain thing because this stuff all seems obvious to me, and I think it's because my vantage point is different, and I realize as I am I'm seeing things through a different prism than you as traders and retail traders and trading rooms and education circles and such. This stuff just might not be as obvious. It is obvious to me, and I think that with some effort that people really could reduce the trade frequency in a way that can offer them the opportunity to extend the life of their account to give them at least a chance to make this work. All right, this kind of goes back to the catching a runner thing. It's just a hard thing to do, but I do believe that that's the public enemy number one. So I wanted to dedicate a slide to that. Maybe you can come back and look at that as well. All right, so if you are a TOS user, TradeStation user, or you're with one of those one-man shop / indicator sales firms I mentioned, if you're thinking about getting started with futures trading, if you want access to a low cost ongoing practice environment, okay, you just want to fund an account just to kind of have ongoing access to the platform, that's fine. Or if you're looking for a place to start over, please consider coming here to us if you're not already. All right, there's a lot of stuff that we've got that fits nicely into a spreadsheet like margins and such, but there's a lot that can't fit into the spreadsheet, like the infrastructure, the lightweight nature of the platform, and I really hope that serves as a reinforcement for why people land here. So definitely appreciate everybody listening to that event or these comments. But I did want to post some of these links here so everybody can see the chat box. There's a bunch of questions that came up that I want to answer before we go. I'm going to put the links in here that I was referencing. So I have a YouTube playlist that is called Patrick's Corner. Okay, I update this event will be there. I update it usually a couple of times a week. It's usually a response to questions that I get a lot of. So during rollover week, I got a lot of questions about slippage because people were seeing slippage on stop orders and the NASDAQ and they were asking why and such. So I did a video about slippage and what is the role of us or Transact in the transaction? What does it, do we cause it? Well, the answer is no, but how does it actually work? That's something that we got a lot of questions about. I did do a webinar, an entire webinar on that concept of MPD lines the other day. So I've just posted that as well. I highly recommend that. We got a lot of really good feedback on that one. My cousin, Marcus, I don't know if he's still paying attention, but he does something called the tip of the week. And that's a really great video to watch. Every week he makes a new video that usually is a response to questions he gets. So it might be some little feature on the trading platform. It might be, something on the charting. It might be, he got the same question 10 times in one day and he wants to, kill 10 birds with one stone. He makes a video, it shows up on YouTube, and that's a really great one to watch. And if you, or take a look at, frequently. And if you want to learn more about the margin requirements that we talked about earlier, there's the margin page as well, directly on the Infinity Futures website, okay? We are listening now to people for feedback more, in my opinion, more than we ever have as a company. Suggestions, things you want to see on the charts, things you want us to do, topics you want covered. Please feel free to write me back and let me know. My email address is just, in an effort to save everybody from, bounced emails, is just pz@infinityfutures.com, pz@infinityfutures.com. If you have questions, comments, feedback, love it, hate it, ideas, again, things you want us to cover in the videos, we would love to hear from you. It means more right now, especially with the advent of AT charts than it really ever has. So please take us up. We are serious about aggregating that feedback in a way that can produce results. Very open to suggestions. So please feel free to send me some of those details or questions. There were some questions earlier about, Jerry had a question about the simpler trading stuff. We are actually in the process of integrating a large amount of their stuff, Jerry, into AT charts. So the squeeze is already there. There'll be a few more that that come through in the very near future. Some of the stuff that come with access, I think, to the futures room will be there, and then their other stuff will be there too. Yeah, Jim, no problem at all. Thank you for the feedback. Michael says that Renko charts help keep you in. Fair argument. Yeah, we do offer Renko both on AT charts, and then Sierra has a pretty nice Renko functionality as well. Let's see. Yeah, there were some comments confirming what I mentioned earlier about the margin requirements at Thinkorswim. Yeah, good. They used to mail the statements and it took days to get a statement. Yeah, you must have been in the business for a really long time there, Jim. Okay. All right, good. Well, I think that's probably where we'll leave it, folks. I really do appreciate the comments. Hopefully you got something out of it. We'll have a recording up, I'm sure, here at some point in the very near future. You probably get an email about it. One thing I want to mention too before you go is small group training. We've done this successfully with a number of small groups. If you are in a little Skype group, or you have a little subset of the trading room that you're in where the 10 or 12 of you guys and gals communicate on the side, if you would like us to schedule a private sort of event for you where we can talk about the platform in the context of what you're doing, that sort of thing, we would be happy to do that. I've had some really good experiences with some small groups, and it's very pointed instruction geared specifically to the way that y'all are trading. We can definitely make that happen as well. All right. Okay, well, great. Thanks everybody for listening. I do appreciate it. I will read some risk stuff here one more time, and then we'll close the room up. We'll see you next time. Don't forget to tell all your buddies about us. We really appreciate your time. Thank you. All right, folks, trading futures, options on futures and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Past performance is not indicative of future results. All right, thank you, folks. Talk to you soon.